In the glittering world of tech startups, few stories burned as brightly or crashed as spectacularly as Bolt's. It was a company that seemed to embody the very spirit of Silicon Valley, bold, ambitious, and unafraid to dream big. From the outside, Bolt was a beacon of innovation, a shining example of what could happen when visionaries and investors came together to chase the next big thing. At its peak, Bolt wasn't just a company, it was a phenomenon, promising to revolutionize online shopping with a single click. The team was young, energetic, and driven by a shared belief that they could change the way the world bought and sold online. Their mission was simple, yet audacious: to make checkout so seamless it would feel like magic. BlackRock, General Atlantic, and other financial giants saw the potential and poured in hundreds of millions, fueling Bolt's meteoric rise. With each new funding round, the company's valuation soared, eventually reaching an eye-popping $11 billion in early 2022. Investors and employees alike were swept up in the excitement, convinced they were witnessing the birth of the next tech titan. The media celebrated Bolt as the future of e-commerce, led by its charismatic founder Ryan Breslow. Headlines hailed him as a visionary, and his bold claims about Bolt's technology made for irresistible stories. Conferences, interviews, and magazine covers followed, painting a picture of unstoppable momentum. But behind the headlines, the reality was far less glamorous. The pressure to deliver on sky-high expectations was relentless. Executives scrambled to keep up appearances even as internal challenges mounted. The glossy exterior began to crack, revealing a company struggling to keep pace with its own narrative. The $11 billion valuation was more fantasy than fact, masking deep cracks in Bolt's foundation. Numbers were massaged, projections stretched, and the line between ambition and reality grew dangerously thin. Investors started to ask tough questions, and the answers were rarely reassuring. The technology struggled to deliver on its lofty promises, and the once-praised culture was turning toxic. Developers faced impossible deadlines, teams clashed over priorities, and morale began to erode. What was once a place of inspiration became a pressure cooker of stress and uncertainty. Bolt became two companies, one, the public symbol of Silicon Valley's hype machine, and the other, a private chaos of a business straining under its own ambition. The gap between the company's polished image and its internal struggles grew wider with each passing month. The gap between story and substance grew unsustainable. As the cracks widened, employees and investors alike began to lose faith. The dominoes started to fall, and the consequences rippled through the company at every level. Bolt's rise and fall is a cautionary tale, a reminder that in tech, gravity always wins. No matter how high a company soars on hype and hope, reality eventually catches up. The story of Bolt is a modern-day Icarus, flying too close to the sun on wings of ambition. This is the story of Bolt's painful public landing, a lesson in the dangers of believing your own legend, and a stark warning for every startup chasing the next big thing. Every tech saga starts with a bold idea. For Bolt, that idea came from Ryan Breslow. He saw online shopping's biggest pain: the tedious checkout process. Breslow dreamed of a universal one-click checkout for the entire internet, a seamless experience for shoppers and merchants alike. Investors loved it. Bolt wasn't just a tool, it was pitched as the new backbone of e-commerce. The timing was perfect, the pandemic fueled e-commerce, and investors were desperate for the next big thing. Breslow's pitch was more than a product. It was a movement to empower independent retailers against giants like Amazon. The promise of network effects and exponential growth was irresistible. Bolt's vision, charismatic founder, and market timing set the stage for its rocket-like ascent. Investors saw legendary returns on the horizon. The spark was lit, and Bolt was off to the races. But vision alone wouldn't be enough. With a compelling vision and a bold promise to revolutionize online checkout, Bolt entered the tech scene with a bang. The company's founder, brimming with confidence and charisma, painted a future where one-click payments would be accessible to every merchant, not just the giants like Amazon. Investors were captivated by the story, a scrappy startup taking on the biggest names in e-commerce. And with a founder who could sell that dream with infectious energy, Bolt's pitch meetings became legendary in Silicon Valley. The company's narrative was irresistible: a disruptive product, a massive market, and a leader who seemed destined for greatness. Bolt quickly became a VC favorite, with investors eager to get in on the ground floor. The startup's early backers boasted about their involvement, and word spread fast among the venture capital elite. In the frenzy of 2021 and early 2022, when tech valuations were soaring and capital was cheap, money poured into promising startups. Bolt was at the top of every investor's list, seen as the next big thing in fintech. Each funding round was bigger than the last, with Bolt's valuation climbing at a dizzying pace. The company's momentum seemed unstoppable, and every new investment was met with celebration and headlines. Major players like BlackRock, General Atlantic, and Westcap lined up to invest, pouring hundreds of millions into Bolt and fueling its rapid expansion. Their involvement only added to the company's credibility and allure. The focus wasn't on profits or perfecting the product, it was all about scale. Bolt hired aggressively, expanded into new markets, and chased growth at all costs, believing that market dominance would solve everything else. Bolt's valuation soared to $11 billion, turning it into a symbol of the era's excess and ambition. The company was hailed as a unicorn, a rare breed in the startup world, and its founder became a media sensation. The media loved the story: a bold founder, a disruptive product, and a unicorn company challenging the status quo. Headlines celebrated Bolt's meteoric rise and the audacity of its vision. Hype attracted top talent and more merchants, reinforcing Bolt's aura of invincibility. The company's rapid growth drew in ambitious employees and eager partners, all hoping to be part of the next big success story. From the outside, Bolt looked unstoppable, a rocket ship destined for greatness, with no sign of slowing down. The company's brand was everywhere, and its future seemed limitless. But the ride to the top was built on hype, not substance. Beneath the surface, questions lingered about Bolt's actual performance and whether its technology could truly deliver on its promises. The cracks were already forming beneath the surface, hinting at challenges that would soon become impossible to ignore. Behind Bolt's public triumph, serious problems were brewing. The one-click checkout tech wasn't as seamless or widely adopted as promised. Merchants struggled with integration, and the shopper network was smaller than advertised. A major customer sued Bolt, alleging it had overstated its capabilities and cost them millions. The lawsuit, though settled, shattered Bolt's credibility. Internally, progressive policies like unlimited PTO backfired, fueling burnout and resentment. Reports of mismanagement and chaos surfaced as the company grew too fast for its own good. The pressure to justify sky-high valuations led to corner-cutting and confusion. Positive press masked deepening cracks, but the foundation was unstable. The unraveling had begun. In late 2022, the world changed. Inflation soared, interest rates rose, and the tech funding party ended. Investors now demanded profits, not just growth. Bolt's high cash burn, once a badge of ambition, became a glaring liability. The company's lavish spending was unsustainable without fresh capital. A last-ditch fundraising attempt at a $14 billion valuation failed. Layoffs hit hard, hundreds lost jobs, offices closed, and budgets were slashed. Headlines shifted from celebration to near bankruptcy. The narrative flipped. Bolt was now a cautionary tale. Ryan Breslow returned as CEO, trying to steady the ship amid chaos. Leadership churn only deepened the crisis. Bolt had built itself for a world of endless capital, a world that no longer existed. The consequences were swift and brutal. Survival was now the only goal. With Bolt on the brink, Ryan Breslow returned as CEO in March 2025. His comeback signaled both hope and desperation. Breslow's bold move pitched investors for $600 million, half for Bolt, half for his new wellness startup, Love.com. The ask was met with skepticism. Investors balked at funding a struggling company and an unrelated venture. Even more audacious, Breslow wanted to maintain Bolt's $11 billion valuation, unthinkable in the new market reality. Tech valuations had plummeted, and investors demanded fundamentals, not hype. Breslow's gamble risked alienating the very people Bolt needed most. The founder's return was a turning point, a last stand to save the company. Breslow had to rebuild trust, prove Bolt's technology, and convince a skeptical market it was still worth saving. The fight for survival was on. The odds were long, but the alternative was failure. Bolt's future hung in the balance. Breslow knew Bolt needed more than money, it needed a new way to operate. The company had to rethink its entire approach to business, focusing not just on growth but on sustainability and resilience. The era of hypergrowth was over, efficiency and discipline were in. Companies could no longer afford to burn through cash without a clear path to profitability. It was a time for strategic pivots and smarter resource allocation. Bolt overhauled its culture, starting with the end of unlimited PTO. The old system was unsustainable and often led to burnout and inefficiency. Employees needed a structured way to recharge. In July 2025, a mandatory 4-week vacation policy replaced the broken system, aiming to protect employees from burnout. This new policy was designed to ensure that everyone took the time they needed to rest and rejuvenate. The company also eliminated its traditional HR department, replacing it with a leaner people ops team. This new team was more agile and better equipped to handle the dynamic needs of a modern workforce. Managers were empowered to handle team issues directly, cutting bureaucracy and speeding up decisions. This change fostered a more responsive and engaged work environment. The goal was a lean, high-performance culture built for survival. Bolt aimed to create a workplace where every team member could contribute effectively and feel valued. To signal a new era, Bolt partnered with Palantir to integrate advanced AI into its platform. This partnership was a strategic move to enhance the company's technological capabilities. The focus shifted to efficiency, fraud detection, and delivering real value to merchants. By leveraging AI, Bolt aimed to provide more secure and efficient services. Bolt wanted to prove it was investing in the future, not just cutting costs. The company was committed to innovation and long-term success. The company was finally trying to deliver on its original promise. Bolt's transformation was a testament to its resilience and vision for a sustainable future. Bolt's struggle played out against a brutal fintech winter. The era of growth at all costs was over. Profitability was the new mantra. VC funding for fintech startups plunged and investors demanded hard numbers, not hype. Bolt, with its history of overpromising and leadership turmoil, became a tough sell. While others pivoted to core, profitable lines, Bolt was still chasing a business model built on outside capital. The industry's correction exposed Bolt as an extreme example of tech excess. Companies with real fundamentals survive. Those built on hype, like Bolt, faced a harsh reckoning. The fintech winter was unforgiving. Bolt's story was a warning to the entire sector. Bolt's saga delivers a clear lesson. A high valuation isn't a business. In bull markets, it's easy to mistake hype for real traction. Bolt's $11 billion valuation was built on story, not substance. Hype attracts capital and talent, but execution is what sustains a company. Bolt excelled at narrative, but faltered at building reliable tech and a healthy culture. Leadership churn and failed policies like unlimited PTO created chaos, not clarity. True company culture is built on trust and consistency, not perks. Bolt's story is a digital age cautionary tale. Don't believe your own hype. Business fundamentals, real products, happy customers, and a path to profit are what matter. Bolt's ghostly valuation will haunt Silicon Valley as a reminder. Reality always wins.